Hello students, welcome to BYJU'S IAS. Welcome to a session on economy this week, wherein we'll be taking some of the very important articles that have appeared in various business related newspapers for a time period between 30th of November to 5th of December 2018. For reference, I'll be taking the articles from newspapers such as Business Line, Financial Express, Hindu, Business Standard, Live Mint, etc. So let's begin this particular discussion. The first article is related to the new direct tax code. Now please understand, under the total concept of a taxes, there are two types of taxes. One is a direct tax and the other one is indirect tax. Under the concept of a direct tax, the earlier government had proposed a reformed version of a direct taxes code. That is basically the restructuring of the direct tax structure in case of India. And under the indirect taxes, the government of India had proposed the idea of a GST, which has been carried on but with certain changes by even the present government of India, and today we are in the process of successful implementation of the concept of a GST. Whereas in case of the direct taxes, the DTC, that is direct tax code, was shelved by the present government. They basically said they will not be introducing this particular DTC, rather they have set up a very important committee which will be giving recommendations to restructure this particular idea of a DTC. This particular article is about the same recommendations or the committee which will be giving recommendations with respect to the direct taxes in India. Now, please understand this. There is an urgent need of restructuring or reforming the direct tax structure in India for a simple reason. There have been various issues which have been plaguing this particular direct tax structure. With respect to indirect tax, we have already implemented GST and we are in the process of stabilizing this particular structure of a GST. Whereas various recommendations which have been given by various experts with respect to direct tax code are yet to be implemented by Government of India. So in this particular regard, what are some of the issues which are plaguing the direct tax structure in India? One is of tax evasion. There is a huge amount of a tax evasion which is happening in case of India. Now please understand, there is also a term called as avoidance. You will see in case of India, the taxpayers avoiding the taxes as well as evading the taxes. Now please understand, there is a very important difference between both the terms evasion as well as avoidance. To put it in simple terms, avoidance is legal whereas evasion is illegal. If you are caught avoiding, it basically means that you are simply using one of the loopholes in the tax, and the Government of India will introduce certain reforms to plug this particular loophole. Whereas if you are caught evading the tax, then Government of India will come hard on you, will impose penalties and will collect huge amount of taxes from this particular person or an assessee who has evaded tax. So various taxpayers in case of India are evading taxes as well as avoiding taxes. That has been one of the very important issues of the direct tax. Whereas the other very important issue which is plaguing the direct tax structure is of litigations. Since various provisions in the Income Tax Code of or Income Tax Act of 1961 are open to different interpretations or subjective interpretations, there have been a large number of litigations in case of India. As per one of the estimates, the tax authorities in case of India are one of the largest litigants in the judicial system. It is said that under the direct taxes, more than 1.37 lakh cases are pending or have been filed by the tax authorities, whereas under the indirect taxes, around 1.45 lakh cases have been filed by the tax authorities. One of the biggest issues of these many number of taxes filed by the tax authorities has led to high number of cases pending at various levels of judiciary. The appellate, the high courts as well as the supreme courts are burdened by this particular number of cases filed by the tax authorities. Not only this, it has been stated that the sum total of the value of the assets which are stuck up because they are being litigated as per the economic survey is around 7.58 lakh crore rupees, which is a very huge number. And in terms of GDP, it has been pegged at around 4.7% of GDP. So you can see that these number of cases are not only burdening the judiciary, they are also leading to lower investment in the infrastructure sector as well as other sectors also. So as a result of this, the Government of India has set up a panel, and this particular panel has already stated that their objective will not be to completely restructure the tax system. Their objective will be mainly to provide clarity in terms of taxation provisions. I'll repeat the statement. The committee is expected, or the panel is expected, to provide recommendations which will provide more clarity in terms of the provisions of the taxation system in India. How it can be done? The panel is basically looking at various interpretations which have been given by various judiciary over a period of time. They are going to incorporate these particular interpretations so that in the future there will be no subjective interpretations or different interpretations on these particular provisions of IT Act of 1961. So, main of focus or main objective will be to provide clarity. Now, apart from this, very recently the government of India has also stated that there will be certain changes, or has already announced certain changes with respect to the thresholds which will be implemented, which will reduce the litigations from the taxation department. What do I mean by this particular threshold level? Let's say basically there is a person X. The income tax officials basically say this particular person has to pay this much, or let's say Y rupees of income taxes to the government, whereas this particular person contests this particular notice of income tax authorities. This will lead to litigation or long drawn litigation in case of India. Now, government of India basically says the value of the tax demand that has been raised by the income tax department, there will be certain threshold which will be fixed. For example, earlier for filing a case or a petition in case of a tax demand, the threshold limit at the appellate level was 10 lakh rupees, at the High Court level was 20 lakh rupees, and at the Supreme Court level it was 25 lakh rupees. Now, very recently Government of India, in order to reduce the number of tax cases and to reduce the stuck up value of the assets, has increased this particular limit to 20 lakh rupees, this one at High Court level to 50 lakh rupees, and finally at the Supreme Court level it has been fixed at 1 crore rupees. So, basically with increase in the threshold limit, the number of cases which are filed by the income tax department or taxation department will come down. And since the number of cases or the petitions filed will come down, the burden on judiciary will come down, the value of the assets which are stuck up will also come down. It is stated that with introduction of new threshold limit levels, the number of cases will come down by around 37%. So, these are some of the very important points related to the tax code. The second article is related to the corporate tax rate cut, which is being demanded by various authorities as well as various industry experts. Now, please understand, Government of India on one side imposes a corporate tax and on the other side gives a certain exemptions or subsidies to the industries, which is usually a part of a tax expenditure. Now, the statutory rate of a corporate tax in case of India is 30% as announced by Government of India, that is a corporate tax, plus the SEZs which are collected by the government from these particular companies. Overall, the statutory rate comes at around 33%. On the other side, the subsidies which are given by Government of India or the exemptions which are given by Government of India to these particular industries for the financial year 2015 and 2016 accounted for more than 68,000 crore rupees. So, on one side the government collects corporate taxes, on the other side the government gives certain exemptions, as a result of which, though the statutory rate is around 33%, the effective taxation rate for 2015 and 2016 was somewhere in the range of 28%. Now, what is the difference between the statutory rate and the effective taxation rate? The difference is from the statutory rate, I will deduct the tax expenditure that is incurred by Government of India in the form of exemptions or the subsidies given by the government to these particular industries. I will give an example. Let's say hypothetically, here is a company which has earned a revenue of 100 crore rupees. On this, let's say hypothetically corporate tax is 30 crore rupees. But since this particular company is involved in manufacturing of a particular product, what if the Government of India announces an exemption of a tax in the form of 5% of the total revenues? So, the statutory rate will be how much? 30%. But since there is an exemption of 5% given, the effective rate will be 25%. So the statutory rate is 30%, effective taxation rate will be 25%. So in the same way, in case of India, the statutory rate comes at around 33% and the effective taxation rate for the year 2015 and 2016 was at around 28%. So the government of India basically said that these particular exemptions or subsidies are being cornered by larger companies or bigger companies. Why? They have dedicated a team of various experts who will recommend in which areas the companies can get or can use these particular exemptions or subsidies, which on equivalent footing cannot be done by a company such as MSME units. So government of India basically said, on one side, you people are saying that 33% corporate tax rate is very high, and on the other side, you are consuming huge amount of subsidies which are being cornered by very small number of companies. So basically, I'll be reducing the corporate tax rate, but on the other side, I'll be phasing out these particular subsidies or exemptions which are given to these particular sectors. So in this particular regard, Government of India very recently has announced that the corporate tax rates for companies with a turnover or revenue of up to 250 crore rupees will be reduced from 30% to 25%. Whereas for all the other companies with a turnover of more than 250 crore rupees, the taxation or the corporate tax rate will continue to remain 30%. Now please understand, one of the very important considerations that these industries do is the corporate tax rates must be lesser. Why it should be lesser? Lesser the tax rate, that is a corporate tax rate, more attractive will be this particular scenario for not only the domestic investments but also for the foreign investments. For example, very recently the US government has reduced the corporate tax rates from being around 40% overall to around 25%. I am using the term 40% overall for a simple reason. In case of US, the corporate taxes will not only be imposed by the central government but will also be imposed by the states. In case of USA, the central or the federal government imposed around 35% corporate tax, which has been reduced to 20% or around 21% now. Whereas in case of India, it comes at around 33%, which is much higher, and the argument of various industries is this reduction of corporate tax by USA will make that region or that country more attractive for the investments. Apart from that, very recently European Union has also announced that they are thinking of cutting down the corporate tax rates. Already in case of UK, the corporate tax rate is 19%. They are thinking of cutting it down further lesser to attract the investment. What about the other countries? In case of Germany, it is around 30% plus. In case of China, it is 25%. Overall, around the globe, the average corporate tax imposed is around 23%. So keeping in mind all of this, there has been a huge demand for reduction of corporate taxes in case of India, especially by CII, which says that the corporate taxes in India should be reduced to 18% from 30%. So keeping in mind all of this, what is the viewpoint of the government now? The government says, one, the corporate tax cuts will not be given anytime soon. Maybe in the future, they may think of giving a better corporate tax cut to the industries. But beyond this particular reduction which has already been announced, they will not be announcing any kind of a corporate tax cut in the future or near future. The argument which has been put forward by Government of India is, one, revenue which will be foregone. Already we have seen that the Government of India is finding it very difficult to meet the fiscal deficit target because of a lack of collection of GST revenues. Upon this, the Government of India will not enter into venturism and give a tax rate cut for the corporate taxes, which will again dent the immediate revenues of the government. The Government of India says that on one side, the concessions that are given in the form of a tax exemption or subsidies to these particular industries will benefit these particular industries over a period of time, that is in the range of around 7 to 10 years. Whereas if the Government of India cuts the corporate tax today itself, the revenues will start getting affected from this financial year itself. So keeping in mind all of these particular arguments, the Government of India stated that the companies should not expect any kind of a tax rate cut or a corporate tax rate cut in the near future. After couple of years, the government may start thinking again to give a better corporate tax rate cut to these particular companies. So this is the gist of this particular article. The third article is on IAS UDAN, International Air Connectivity Scheme UDAN. Now, earlier the government of India has launched a very important scheme to connect the unconnected aviation markets in India, that is UDAN, which is nothing but Ude Desh Ka Aam Nagrik. Under this particular scheme or program, the government of India basically said various air operators or airline operators basically may look at various routes which are there in the list and may start bidding for these particular routes. Under this particular UDAN scheme, the route will be auctioned and will be exclusively given for an airline operator for a period of 3 years. And in return, this particular airline operator basically has to sell 50% of the seats in this particular flight at subsidized rates. This has been a very important program of Government of India to promote the connectivity and promote air travel in case of India, because various surveys have basically stated that only around 2% of the population in case of India travel by air. And this particular air travel has been promoted at affordable prices under the concept of UDAN. Very recently, the Government of India has put forward evaluation of a UDAN program. Some of the very important achievements that have been done under UDAN is more than 30 airports, or to be more precise, 36 airports have been connected because of the UDAN program itself. For the first time, all the states in India have come on the aviation map, and the number of travelers has also increased thanks to this particular UDAN scheme. As a result of this, the aviation market in case of India in the last 2 years is said to have been grown by more than 50%. And because of this particular program and increase in the air travel in case of India, India today is the third largest civil aviation market in the world. This is a very good news not only for the domestic operators but also for international operators. Keeping in mind all of this, the Government of India has basically announced the third round of bidding under this particular UDAN scheme. But please understand, the basic difference between earlier 2 rounds and the third round will be, in the earlier 2 rounds, the routes which were bid were basically the domestic routes. Whereas in the third route, the Government of India says they will be announcing the routes which are international routes. Now the Government of India says they want to promote international travel, not only just domestic travel. Now, one of the very important guideline which has been announced under this particular draft guideline has been that these particular routes which will be open for bidding will be only in those states which will promote the UDAN scheme by promoting investment, by having very good policies which will basically help in the successful implementation of this particular scheme. Already the Government of India has announced setting up of IACF, International Air Connectivity Fund. The government says the funds from this particular fund will be used for financing all those operators who will be participating in the implementation of IAS UDAN. And apart from this, another state, that is Assam, has already announced that it will be providing viability gap funding of 1 crore rupees towards the implementation of IAS UDAN from the state Assam. So these are some of the very important points with respect to this particular article. The next article is related to import cover. Now before looking at the term import cover, let's try and understand what is the concept of a forex reserves. Please understand this. Forex reserves will be in the form of 3 components. One will be basket of foreign currencies. Second will be the gold component, and the third will be the special drawing rights which are given by International Monetary Fund for all of its member countries. So the sum total of all of these components, whenever expressed in the dollar terms, will give you the total forex reserves. Again, apart from this, there are other components also, but the most important components are these 3 components. So the forex reserves are very important for any economy, especially India. Why? As all of us know, India is a net importer, which basically means that at the end of the day, there is a net dollar outflow from the domestic economy. And whenever there is a fluctuation in terms of, let's say, rupee exchange rate, and whenever the value of the imports increase because of, let's say, crude oil prices increase, or the tariffs which are imposed by government, so on and so forth, the dollar outflow will keep on increasing. And in the recent times, because of various factors, there has been a net dollar outflow from the domestic economy. As a result of this, the forex reserves, which were more than $420 billion at one point of a time in the beginning of this particular financial year, have fallen down to less than 400 billion now. As of the present numbers, they are somewhere in the range of $390 billion. Now, what is the importance of these particular forex reserves? Always remember this. We come across a term called as a BOP crisis. Now, the BOP crisis will occur in a country wherein it has already exhausted or it is about to exhaust all its forex reserves, and still there is certain net dollar outflow remaining. That is, let's say hypothetically, India blows up all the $390 billion and still there is some payments to be made to some of the exporters from other countries. In this particular situation, we basically say India is on the threshold of a BOP crisis. The last time India suffered a BOP crisis or was on the threshold of BOP crisis was back in the year 1991. Post that, both the government as well as RBI have taken huge amount of measures which have basically ensured that there will be a huge amount of forex reserves which will be present at any point of a time for the dispense. The 1991 situation was so worse that it is said that India only had around certain forex reserves which was sufficient to pay for 2 weeks of imports of crude. But after that, we have started building forex reserves. By the year 2003, our forex reserves were around $100 billion. 2007, they ballooned to $200 billion. 2017 and 18, they have ballooned to $400 billion. But because of various factors, the forex reserves again have gone down to below $400 billion. Now, whenever this variation happens in the forex reserves, there is a term which will be there in the newspaper, that is called as import cover. Import cover basically says that with the present forex reserves, for how many more months can I keep on continuously importing before I exhaust the forex reserves? I'll repeat the statement. With the present value of forex reserves, how many more months of imports can be done before I can exhaust all the forex reserves? Let's say hypothetically, if I'm importing goods worth $10 every month, and if my forex reserves are $100, I'll basically come to a conclusion, my import cover will be 10 months. So presently, what is the issue in news? The import cover has fallen down from 10.9 months to 10.1 months. And always remember this, various international investors usually use the parameter of import cover to evaluate the strength of the currency. If the import cover is very high, it basically indicates that the domestic currency is very strong. If the import cover keeps on falling, it basically means that the domestic currency is growing weaker and weaker. Apart from that, another very important term that has been given or point which has been given in this particular article is the short-term debt to the reserves. Please understand, even this particular term of or the ratio of short-term debt to reserves is very important for a simple reason. Short-term debt basically refers to the debt which has to be repaid within the next 1 year, where the maturity period is less than 1 year. So, if the short-term debt to reserves keeps on increasing, it simply means that there is a higher pressure on the reserves. And that is exactly what has happened in case of India. Short-term debt for India has increased from 24.1% to 24.3%, and this has happened just in a matter of 1 quarter. So basically, the pressure on the forex reserves is actually increasing because of various external as well as internal factors. That is the crux of this particular article. The next article is with respect to SEZs. Before looking at this particular article which is there in the newspaper, Let's try and understand what is the concept of SEZ. SEZ basically stands for Special Economic Zones. These are the enclaves which are set up and operated by the private people or private developers, wherein the private companies, which could be domestic companies or the MNCs, will move into and will conduct their business. But what is the specialty of an SEZ? In terms of a taxation, very liberalized taxation rate will be applicable. What do you mean by liberalized taxation rate? The Government of India under the SEZ policy of 2005 basically stated that for the first 5 years, these companies will not have to pay any corporate tax. Again, I am using the term any corporate tax. For how many years? For the first 5 years. After 5 years, for the next 5 years, that is from the 6th year to 10th year, only around 50% of the corporate tax applicable will be collected from these particular companies. Even in terms of labor regulations, these regulations will be very relaxed for any company which is set up in these enclaves or in these SEZs. The basic objective of a SEZ policy of government was to promote production, promote manufacturing, promote exports, and more importantly, promote employment. And ultimately, if all of these are happening, this will lead to higher GDP contribution. With these objectives, the Government of India proposed the SEZ policy. But over a period of time, there have been certain loopholes which have been misused. There have been certain issues of concern with respect to this particular model of SEZ. For example, one issue has been the Government of India on one side basically said any manufacturing company which is present in the SEZ did not pay any kind of import duty on any import that it does. Why? This manufacturing company will import the commodity for what purposes? For exporting of finished goods. Now, if the import duties are applicable, the cost of inputs for this company will increase. If the cost of input increases, the cost of production increases and the exports will become costlier compared to the same kind of goods which are manufactured in other countries. Hence, these goods which are manufactured in SEZs will lose their price competitiveness. So, the Government of India basically said any import that you do for the purpose of exporting, we will not collect any kind of import duties. But on the other hand, the Government of India has also entered into various free trade agreements, and one of the very important outcomes of FTAs will be import duties will be cut. As a result of this, a non-SEZ manufacturing company is also getting the same kind of a treatment compared to a company which is within the SEZ. Apart from this, another issue which led to a dispute between India and USA government was the exemption of a dividend distribution taxation to any company which was present in a SEZ. US government basically said this kind of an exemption of a dividend distribution tax will basically lead to a distortion of a market and dragged India to WTO. Hence, India had to withdraw, or the Government of India had to withdraw this particular provision of a dividend distribution taxation. So, keeping in mind all of these particular issues, the Government of India basically set up a Baba Kalyani committee to give certain recommendations to ensure that the provisions under the SEZ Act are not contravening, are not against any of the provisions under the WTO guidelines. And this particular committee has given certain very important recommendations. This article discusses these particular recommendations. For example, this committee says that rather than focusing only on the exports from the SEZs, the focus should shift to employment generation. And any company which is given incentive in these particular SEZs, the incentives should be fixed or should be dependent on the employment generation, not the exports. The basic objective of shifting this particular focus from export-oriented incentive to employment-oriented incentive simply is, if I fix incentives based on the employment generation, this will not contravene any of the provisions under the WTO guidelines. Whereas if I give incentives to promote more and more exports, this is against the WTO guidelines. And very important recommendation is that this committee has recommended that the name should be changed from SEZs to EECs, that is Employment Economic Conclaves. I'll repeat the statement. the name should be changed from SEZs to EECs. That is the second very important recommendation. Third, it has been seen that majority of the units which are set up in SEZs are service oriented units, and the number of units or number of companies which are present in SEZs are around 67% of the total number are involved in the service oriented business, that is information technology, IT and ES based companies. This particular committee says that 1. The service sector units should be expanded to more other service sectors rather than being only focused on IT and ES. The service sector should be expanded, that is more number of or more types of services should be introduced. And apart from this committee also states that manufacturing based units or companies must be promoted within the SEZs. And apart from this, it also recommends that the incentives which are given should be looked at post 2020, and any company which is set up in the SEZ after 2020 should not be given any kind of an incentive. So these are some of the very important recommendations which are given by Baba Kalyani committee. This is the crux of this particular article. The next article is related to some of the tax disputes which were resolved between India and China through the concept of MAPs. Before looking at the gist of the article, let's try and understand the concept of MAP, Mutual Agreement Procedure. Mutual Agreement Procedure is basically a dispute settlement mechanism which will be used by MNCs to resolve the disputes related to double taxation. I'll repeat the statement. Mutual Agreement Procedure is a dispute settlement mechanism. This will be done out of the court settlement, which will be used by the MNCs to resolve the issues of or the disputes of double taxation. I'll give an example, you will understand it, which is one issue. Another concept is transfer pricing practice. Transfer pricing practice is basically nothing but it's a practice of costing the transactions or evaluating the transactions which are happening between the related companies or the subsidiaries of an enterprise. Now, I will take an example which happened in case of India, then explain to you what is the transfer pricing as well as concept of a MAP. Earlier, there is a company called as Nokia. There is a company in India, Nokia India, and the mother company or the headquarters of Nokia was in Finland, which was Nokia Corp. Now, within Nokia India, there was a manufacturing unit in Chennai, that is Sri Peramburu, and this particular manufacturing unit basically sourced some of the software from this particular company, Nokia Corp. From 2006, it sourced the software and paid the money to this particular company. But please understand, this particular payment that was done by Nokia India was basically in the form of, let's say, purchase transactions recorded in the balance sheet. But the government of India argued that whenever such transaction happen between related companies or within the enterprise, the entry in the balance sheet should read as a transfer of royalties and not as purchases as it was recorded by Nokia India. Now, the government says whenever the royalties are transferred like this, these royalties are applicable for withholding tax. What do you mean by withholding tax? Let's say I am transferring 100 rupees and the withholding tax is 10%. Before the transfer, I will have to withhold 10 rupees, give it to Government of India and transfer remaining 90 rupees to the other party. This is a concept of a withholding tax. So, again, the Nokia India purchased certain software from Nokia Corp from Finland and made certain payment. And they recorded, that is Nokia India recorded this as purchases in their balance sheet, but Government of India said this is a royalties transfer, and as per the DTAA which was signed between India and Finland, the royalties would be taxed by Government of India at 10%. And under this particular DTA, the tax authorities in India sent around 1600 crore worth of a tax notice to Nokia India. That is the reason why the Sri Perambur plant of Nokia was not involved in an agreement between Microsoft and Nokia when Microsoft purchased the Nokia company. And please understand, these kind of transaction between two units of the same enterprise are called as transfer pricing. And this particular issue between the tax department of India and the Nokia company was resolved through the MAP system, which was a part of the double taxation avoidance agreement between India and Finland. As a result of this particular issue was resolved very recently out of the court settlement. So this is a concept of MAP as well as a transfer pricing practice. Now what is there in this particular article? This article basically lists out three very important points. One, that India and China have got MAP, and within this particular concept of MAP, very recently they have resolved 12 cases of double taxation. First point. Second point, India has got MAP agreements with various countries. And third point, India on the other hand has also signed a protocol to amend the double taxation avoidance agreement with China. So these are the three very important points which have been mentioned in this particular article, apart from the basic concept of MAP as well as transfer pricing practice. So let's have a look at some of the questions, starting with the multiple choice questions. Question number 1, consider the following statements about MAP, that is mutual agreement procedure. First point, it is used to settle double tax issues out of the court. Yes, that's correct. India has MAP with US, UK and Japan. In the previous article itself we have seen that India has got agreements with lot many countries, and these are the three countries in the table itself. So first statement is true, second statement is true, the right option will be option C, both the statements are true. Second question, consider the following statements. Import cover is the number of months of imports that could be covered for by a country's international reserves. Correct? We have already seen the concept of import cover. Import cover is an important indicator of the stability of a currency. Yes, it is used as a measure of a stability of currency. So again, for question 2, option C will be the right option. Question number 3, consider the following statements. SEZs are developed and maintained by the respective state governments. No, this is wrong. Developed and maintained by the private developers. That is one of the very important features of SEZs. SEZs are regulated by the Companies Act of 1956. No, SEZs are regulated under the SEZ Act of 2005. So second statement is also wrong. So the right option will be option D. Both the statements are false. Again, two descriptive questions based on the current affairs itself. The first question is discuss the issues with the direct taxes in India. Though I have touched around 2 or 3 issues which are plaguing the direct taxes, there are lot many other issues which are plaguing the direct taxation structure in India. Apart from this, also give certain recommendations. What can be done in the coming days to resolve these particular issues of a direct tax structure in India. Second, discuss the issues which are plaguing the SEZ model and give recommendation. We have already discussed some of the issues, and also I have given certain recommendations of the Baba Kalyani report. So go through this. This is the second question. Both are for 250 words. So these are some of the very important articles as well as the questions related to these particular articles for a time period between 30th November to 5th of December 2018. Thank you. Have a good day.